Based on recent developments, something unusual is happening in the intersection of political energy markets and domestic industrial policy. We are seeing a profound decoupling between geopolitical risk and investor sentiment that challenges traditional economic logic. On one hand, the Federal Reserve is issuing warnings about financial stability, yet on the other, the S&P 500 recently reached an all-time high of nearly 7,400 points. To understand why the markets are seemingly looking past a conflict in the Middle East, we have to look at the specific mechanics of the current pressure environment. This isn't just about oil prices or interest rates. It is about a fundamental restructuring of how the United States secures its energy and its supply chains while simultaneously engaging in a high-stakes military and economic standoff. If we look at the data from May 8, 2026, the picture becomes even more complex, revealing a strategy that is as much about domestic manufacturing as it is about overseas deterrence. Think of the global economy right now as a high-performance engine running on a fuel mix that is increasingly volatile. Since the initiation of military actions on February 28, the world has been holding its breath regarding the Strait of Hormuz. Iran's decision to halt commercial shipping through this narrow passage has effectively constricted the world's most vital energy artery. This has pushed Brent crude to over $100 per barrel, settling recently at $101.29. For the average American, this translates to gasoline prices averaging $4.50 a gallon, the highest we've seen in nearly 4 years. Yet, despite these headwinds, U.S. employers reported adding 115,000 jobs this month, which was double what most economists were expecting. This raises a critical question. How can the labor market remain this resilient when the cost of energy, the literal lifeblood of industry, is spiking so dramatically? The answer may lie in the massive, ongoing capital shift toward artificial intelligence infrastructure. Analysts suggest that the scorching stock market is being insulated by massive spending from tech hyperscalers. Investors seem to be betting that the productivity gains from AI will eventually outpace the inflationary drag of the Middle East conflict. However, the Federal Reserve remains far more cautious. In its latest financial stability report, the Fed identified the ongoing war and the resulting oil shocks as the top concern among its survey respondents. There is a clear tension here. 75% of financial experts see geopolitical risk as the primary threat to the system, while the equity markets continue to climb. This suggests that while the market is currently discounting macroeconomic energy risks, it is operating on the assumption that a resolution is near. But is that optimism supported by the facts on the ground? If we look at the events of the last 24 hours, the narrative of a tenuous ceasefire becomes much harder to maintain. While some financial reports lean into the hope of a resolution, military reporting confirms that U.S. forces recently fired on and disabled 2 Iranian oil tankers in the Strait of Hormuz following an overnight exchange of fire. This indicates that while diplomatic channels may be open, the operational reality is one of active combat. This gap between market perception and military reality creates a significant curiosity gap. If the markets are banking on a resolution to see ship movements resume in the Strait, what happens if the strategic positioning currently underway becomes a long-term fixture of the region? The Federal Reserve's warning about a potential decline in asset prices if inflation remains high is a sobering reminder that this balance is incredibly delicate. According to recent reporting, this conflict isn't just being fought with hardware in the Persian Gulf. It's being fought with spreadsheets in Washington. On May 8, the U.S. Treasury Department announced a new round of sanctions targeting 10 individuals and companies across China, Hong Kong, the UAE, and Belarus. These entities are accused of being the primary procurement network for Iran's weapons sector. To put the scale of this into perspective, Iran currently has the industrial capacity to produce approximately 10,000 drones per month. By targeting the intermediaries that supply the components for these systems, the U.S. is attempting to leverage its financial reach to degrade Iran's military output without necessarily escalating to a full-scale ground engagement. It is a calculated move to increase the economic pressure environment while keeping the conflict contained. However, this strategy of economic leverage is creating unexpected friction points within the United States, particularly in the renewable energy sector. This brings us to a piece of legislation passed last year known as the One Big Beautiful Bill. This policy was designed to stimulate domestic manufacturing, but it included a strict provision. Clean energy subsidies are restricted for any company with more than 25% Chinese ownership. Now we are seeing the unintended consequences of this strategic positioning. U.S. solar installers, banks, and insurers are actively withholding financing, and severing ties with solar panel factories located right here on American soil. Why? Because those factories were originally built or are partially owned by Chinese firms. Think of it like this. The US is trying to build a new energy house, but it has just discovered that a third of the bricks were manufactured by its primary geopolitical rival. Current data shows that China-linked producers account for at least 25 gigawatts of the 66 gigawatts of operating domestic solar module capacity in the US. That is nearly 40% of the country's solar manufacturing capability, currently sitting in a state of financial paralysis. As Keith Martin, a prominent industry attorney, pointed out, this uncertainty is holding up the financing of desperately needed solar and storage projects. This creates a fascinating contradiction in US policy. While the government wants to move away from fossil fuels to insulate the economy from Middle Eastern oil shocks, its own trade and security policies are freezing the very infrastructure needed to make that transition possible. This brings us to a critical pattern recognition insight. The US is currently engaged in a multi-front economic offensive. On one front, it is sanctioning Chinese entities for facilitating Iranian drone production. On the other, it is purging Chinese investment from the American power grid. This simultaneous crackdown provides the US with significant immediate leverage, but it also creates intense friction as we approach the scheduled summit between President Trump and President Xi Jinping in Beijing later this month. Analysts suggest that the upcoming meeting will likely focus on technology and rare earth minerals, but it is impossible to ignore the reality of these active sanctions and factory ownership disputes. The question is whether these friction points will be used as bargaining chips or if they will become permanent barriers to bilateral cooperation. The stakes for this summit are incredibly high because the US grid is facing a looming capacity gap. As data center electricity demands skyrocket to support the very AI infrastructure that is currently propping up the stock market, the US needs more power than ever. If domestic solar expansion stalls due to these ownership disputes, the grid will likely have to depend more heavily on fossil fuels. This would create a circular dependency. To power the AI revolution, the US would need more natural gas and oil, making the economy even more sensitive to the stability of the Middle East and the price of crude. Based on current data, we are seeing a race against time to see which gives way first: the geopolitical tension in the Strait or the legal gridlock in the American solar industry. According to multiple sources, the US Treasury has yet to establish the exact parameters for what constitutes effective control by a foreign entity. This lack of clarity is what is truly freezing the capital. When a bank isn't sure if a project will qualify for a multi-million-dollar tax credit 6 months from now, they simply don't sign the check. This suggests that the one big beautiful bill, while intended to secure the supply chain, may have inadvertently created a temporary vacuum in domestic production. How much longer can corporate margins and consumer spending absorb these high energy costs before the asset price corrections the Fed warned about actually begin? It's a question that every major investor is asking as they look toward the end of the second quarter. The broader strategic implication here is that the US is attempting to rewrite the rules of global trade in real time while managing an active military theater. This is a departure from the globalization at all costs era of the early 2000s. Today, security and resilience are being priced higher than efficiency. We see this in the fact that even with $100 oil, the US is willing to disable tankers and maintain sanctions on key trading partners. It is a move toward a more fragmented but perhaps more controlled economic reality. But this control comes at a price. The national average of $4.50 for a gallon of gas is a direct tax on the American consumer, and while the job market is currently absorbing that blow, the threshold for how much more it can take remains an unanswered question. As we look toward the scheduled Beijing summit, we have to consider the limits of available data. While we know the US is disabling tankers, we don't yet know the exact criteria required for commercial shipping insurers to resume coverage in the Strait of Hormuz. Without insurance, the physical movement of ships won't matter. The global supply chain will remain effectively blocked. This creates an unresolved loop in the global economy. Everyone is waiting for a signal of stability, but the actions on the water suggest that the environment remains highly contested. The market is betting on a diplomatic breakthrough, but the underlying structural tensions, from drone production in Iran to solar factory ownership in the Midwest, suggest that the path to a resolution is far more complicated than a simple ceasefire. The intersection of these two stories, the military engagement in the Middle East and the industrial decoupling from China, reveals a larger thesis about the current American era. The US is moving toward a posture of armed self-reliance. It is a strategy that seeks to eliminate dependencies on adversaries, even if that means enduring short-term inflationary pain and slowing down its own green energy transition. This raises an important question that will define the rest of 2026. Can a modern economy maintain record-breaking growth while simultaneously dismantling its most efficient, yet most vulnerable global supply chains? The answer to that question isn't just in the stock market tickers, it's in the legal definitions being drafted by the Treasury and the tactical decisions being made in the waters of the Middle East. As we look deeper into the structural implications of this shift, we have to ask, what happens to the global order when the world's largest economy decides that security is more important than the price of the bricks it uses to build its future? This leads us to a deeper, more structural question about the path forward. If the United States is effectively pausing nearly 40% of its domestic solar manufacturing to address ownership concerns, what does that mean for the long-term stability of the American power grid? We have to look at this as a two-front challenge. On one side, you have the immediate inflationary pressure from the Middle East, and on the other, you have a self-imposed supply chain disruption aimed at securing national interests. This isn't just about trade. It's about a fundamental shift in how the U.S. calculates the value of its partnerships. According to recent reporting, the U.S. Treasury's decision to sanction 10 entities across China, Hong Kong, and the UAE isn't just a response to current events. It's an attempt to dismantle the financial plumbing that allows Iran to maintain its industrial military output. When we see that Iran is capable of producing 10,000 drones a month, it becomes clear that this conflict is being fueled by a highly efficient, globalized procurement network. Think of it like this. The US is trying to solve a puzzle where the pieces are scattered across 4 different continents and 3 different industries. The One Big Beautiful Bill of 2025 was supposed to be the solution, providing the incentives to build everything at home. But by including the 25% ownership cap, the legislation has inadvertently created a frozen middle in the market. Banks and insurers are risk-averse by nature. If there is even a slight chance that a solar project might lose its federal subsidies because of a complex corporate ownership structure, the financing dries up instantly. Based on current data, this uncertainty is now the single largest bottleneck for American renewable energy. This raises an important question. Can the U.S. afford to let its domestic manufacturing stall at the exact moment it is trying to reduce its reliance on foreign oil? The disconnect between the Federal Reserve and the equity markets adds another layer to this complexity. While the S&P 500 is hovering near 7,400 points, driven by a projected 28% increase in first-quarter earnings, the Fed is essentially waving a red flag. Their financial stability report highlights that 70% of surveyed experts are specifically worried about an oil shock. This suggests that the market might be operating on a best-case scenario assumption, that the conflict in the Strait of Hormuz will be short-lived and that a resolution is imminent. But as we saw on May 8 with the disablement of 2 Iranian tankers, the tactical reality is far more volatile. If the market is banking on a tenuous ceasefire, while the military is still actively engaging targets, we're looking at a significant gap between investor expectations and operational facts. Pattern recognition suggests that we are entering a period where macro blindness might be setting in. When the AI sector is growing this fast, it tends to suck all the oxygen out of the room, making it easy to ignore the fact that the literal energy required to run these AI data centers is becoming more expensive by the day. According to multiple sources, the U.S. grid is facing a massive surge in demand from these hyperscale data centers. If the solar capacity needed to meet that demand is locked in a legal battle over Chinese ownership, the U.S. will have no choice but to lean back on fossil fuels. This creates a strategic irony. The very technology sector that is driving the stock market to all-time highs may eventually be the same sector that forces the U.S. to stay entangled in Middle Eastern energy politics. This brings us to the upcoming summit in Beijing. Based on recent developments, the meeting between President Trump and President Xi is being framed by some as a negotiation over technology and rare earths. However, the immediate friction points are much more practical. The U.S. Treasury has essentially placed a hold on a significant portion of the American solar industry, and they have just sanctioned a fresh batch of Chinese firms for their ties to Tehran. From a strategic positioning standpoint, this gives the U.S. a massive amount of leverage heading into the talks. It's a classic pressure environment strategy. By creating a situation where Chinese-linked investments in the U.S. are at risk, Washington is forcing Beijing to the table with a very specific set of grievances. But the question remains, is this leverage, or is it a barrier that is too high to overcome? Think of the US, China relationship right now is a high-stakes game of chess where both players are also each other's biggest customers. You can't simply knock the pieces off the board without hurting your own economy. This is why the Treasury's definition of effective control is so critical. If the US adopts a strict, retroactive interpretation, it could lead to the forced divestiture or closure of dozens of factories across the American heartland. If they adopt a more flexible approach, they risk appearing weak on national security. The limits of available data suggest that we won't know the answer until the final regulations are released later this year, but the market is already pricing in the uncertainty. This leads to a curiosity gap. What happens to the thousands of American jobs tied to these factories if the ownership disputes aren't resolved? While the job market added 115,000 positions in May, we have to look at where those jobs are. If the manufacturing sector begins to feel the bite of these financing freezes, that resilience could be tested. We are also seeing a shift in the global shipping landscape. The Strait of Hormuz isn't just a geographical choke point, it's a financial one. Even if the US Navy keeps the lanes open, the cost of insuring a commercial vessel in a war zone can be prohibitive. As Michael Arone from State Street pointed out, you need to see actual ship movements and the insurance coverage that follows them before you can say the crisis is over. Until then, the $100 per barrel oil price remains a geopolitical tax on every sector of the economy. There is also an alternative interpretation to consider. Some analysts suggest that the US is intentionally allowing the energy price spike to persist as a way to accelerate the transition away from global dependencies. If gas is $4.50 a gallon, the economic argument for domestic energy independence becomes much easier to sell to the public. However, this is a dangerous game. High energy prices are a primary driver of inflation, and the Federal Reserve has already warned that if inflation remains high, asset prices, including that scorching stock market, could see a significant correction. This raises an important question. Is the US willing to risk a domestic market downturn to achieve its long-term geopolitical goals? Based on current data, the One Big Beautiful Bill was designed to be a carrot, but it's currently being used as a stick. By tying clean energy subsidies to foreign ownership limits, the US is effectively attempting to reshore not just the jobs but the capital itself. But capital is mobile, and investors don't like uncertainty. If the US wants to build a 25-gigawatt solar industry without any Chinese involvement, it has to find a way to replace that capital and expertise almost overnight. In the world of high-tech manufacturing, that is a monumental task. This is the structural implication that many market reports are glossing over. We aren't just changing who owns the factories, we are changing how the entire global supply chain functions. As we look toward the end of May, the focus will inevitably shift to Beijing. Will there be a grand bargain where the US relaxes its ownership rules in exchange for China reining in its support for the Iranian procurement sector? Or are we moving toward a great divergence where the two largest economies in the world operate in entirely separate spheres of influence? According to multiple sources, the US has threatened secondary sanctions against major Chinese financial institutions that sustain the Iranian economy. This would be the nuclear option of economic diplomacy. If the US takes that step, the current trade friction will look minor in comparison. It would represent a total decoupling of the world's two largest financial systems. The underlying pattern here is a move away from just-in-time globalization toward just-in-case national security. For 30 years, the global economy was built on the idea that efficiency was the ultimate goal. If a factory in China could make a solar panel cheaper than a factory in Ohio, the factory in China got the contract. But today, the calculation has changed. Now the question is, can we trust the person who owns the factory? This shift is creating an adjustment period that is both expensive and unpredictable. The $4.50 gas and the $100 oil are just the visible symptoms of a much deeper restructuring of the global order. This brings us to a final, forward-looking insight. We are currently witnessing the birth of a new kind of industrial military tech complex. It's an environment where a drone produced in Iran, a sanction issued in Washington, and a solar project in Arizona are all part of the same story. The AI revolution is providing the economic tailwind that allows the US to take these geopolitical risks, but that tailwind isn't infinite. Eventually, the physical realities of energy and logistics will catch up to the digital optimism of the markets. The real test for the US economy won't be whether it can hit 7,500 on the S&P, but whether it can navigate the next 6 months without the unresolved loop of the Middle East conflict triggering the very financial instability the Fed is so concerned about. As we wait for the results of the Trump-Xi summit, the most important data point to watch won't be the official communiques. It will be the movement of commercial tankers in the Strait of Hormuz and the flow of capital back into those frozen American solar factories. If the insurance premiums for the Strait start to drop and the banks start signing checks for solar projects again, it will be a signal that a new, albeit more expensive, equilibrium has been reached. But if the friction continues to build, we may find that the one big beautiful bill was just the opening chapter in a much longer, much more complicated story about the true cost of energy independence. The question is no longer whether we can afford to decouple from our rivals, but whether we can afford not to, and what kind of world we are willing to build in the process.